Hello and welcome back to the ROI channel, the channel that's obsessed with the scientific art of return on investment. Thank you to all those that are copying the portfolio on eToro. I just received my blue star, so very excited for that. And without you guys, I can't do it. So thanks very much. Appreciate it, and take the opportunity to manage your capital very seriously. And obviously, the aim, as I mentioned throughout the first video, day one of the fund, is the protection and growth of your capital over time. And so that's what I'm obsessed with doing. And today we're going to talk about one particular asset that I've recently bought, and it's set to be the beneficiary of an upcoming bull market in the energy sector. So let's get into it. The company's called Ovintiv, okay? And before we get into it, we're going to just quickly recap our investment formula. So when we're looking at high quality assets, we're looking for those with low debt, a margin of safety, sales growth, strong margins, free cash flow growth, and ideally, if we can get it, a history and a commitment to share buybacks, okay? In short, we want the management to be shareholder focused and providing value to shareholders over time. If you haven't liked and subscribed to the YouTube channel, take a minute just to do that now. I'd really appreciate it. It helps the algorithm and helps me to get the word out there. Moving straight into it. So the quick facts on the company. The company's had a checkered history. Okay, they restructured in, I believe, 2019, and they spun off Synovus Energy, which I'm going to be talking about soon because it's a company I'm very bullish on. And this helped their balance sheet quite a bit. Okay, so oil went through a bit of a nasty patch over the last few years, and so certain companies had to do different things such as restructures, share issuance, which is the opposite of what we're looking for in terms of share buybacks. And so those that have survived are looking to take advantage and capitalize on the coming bull market. They're not looking to repeat the mistakes of the past, and I believe that there's good consensus amongst the producers that they're not going to overproduce, and that they're going to fund production through free cash flow as opposed to finance. So if we look at Ovintiv, we're looking for about 7.35 billion revenue due to come in at the end of 2021. Over the last 5 years, they've been able to grow their top line at nearly 20%, which is very, very good. EBITDA 3.4 billion, 25% compounded annual growth rate, so extremely good margin and margin expansion. Market cap is currently around the 10 billion if I round it up, and we're talking US dollars, so I converted from Canadian to US. Okay, they have two listings. One is on the TSX and one is on the New York Stock Exchange, which is the one that we use for eToro for the Crassus investments. Enterprise value 16.2 billion. They're looking to take off about 4 billion of that over the next year, and then get it all the way down to about 3 billion in debt by the end of 2023, I believe, which is the right thing to do. They're spitting out free cash flow, they're paying down the debt, and then once that's done, they have myriad options to be able to provide capital value to shareholders. They can do it by share buybacks, which, if you see there, they've just recently got approval for a heap of shares that will be around about 10% of the float, I believe. That's what the analyst was saying in the article, which is obviously massive. They'll be able to pay increasing dividends. They're currently yielding 1.7, and they'll be looking to expand a little bit of production, but they're going to be very careful and make sure that any new capex for new production are much wiser projects than what happened in the past. And this is a common theme that we're hearing from all the responsible sort of mid-tier oil producers, which is very, very good. The large caps, forget it. They've been taken over by the eco-terrorists. Price as at time of recording, $38.41, 261 million shares outstanding. Net debt to EBITDA is slightly higher than we would normally like, but they have been able to survive the worst of all worlds in terms of the oil markets from COVID last year. They survived the negative futures, and they're looking to really make it up on the upside. Let's have a look. So obviously, over the last year, this is the price action coming at the end of 2020 and all the way through to where we are today. You can see massive price gains as the oil market has recovered. To put it into percentage terms, which is this chart, if you've held it for a year, you've tripled your money, okay, which is excellent. And so we'll be looking at Ovintiv's performance versus some of the other key stocks that I've got my eye on in the oil and gas sector. Okay. Quickly going through some key points. Ovintiv has been a play that's sort of been on my radar Michael Burry, Dr. Michael Burry, who is the main character of the Big Short. That's how everyone refers to him. He's been around capital markets and done lots of things, but somehow everyone reduces his importance down to that role in the movie. But anyway, that's him. He's now running Scion Asset Management, different from Scion Capital, which is what he ran throughout the lead up to the GFC, and where they made those hundreds of millions of dollars shorting the US housing market. Ovintiv for him makes up 13% of his portfolio. So this is the main way in which he's decided to play the oil sector. He got in a little bit better than I did at around $31.41 from what I can make out from the 13F holdings. Obviously, you don't just buy something because someone else has bought it, but I do look at certain fund managers and have a look at, if I've already made my own decisions about sectors based on my own due diligence, it can give me a direction in terms of which stocks to look at to do my further due diligence. And that's what I started to look more at Ovintiv. It's a reopening place, so demand is going to increase as more people are driving around and getting on planes and using energy much more. Low valuation. I mean, if you look at NTM FCF, if you're wondering what that means, it's next 12 months free cash flow. So we're looking at a multiple. If you were to buy it today, according to my analytics software, that tells me you're paying only 2.8 times next year's free cash flow. Think about that. Like, for the free cash flow of the business, okay, the operating income minus the expense, minus the capex, minus the taxes, you're getting that and a 2.8 multiple. Okay, there are private businesses out there that are selling for more than that, and this is one of the quality mid-tier, or it might be larger than mid-tier oil and gas companies in the world. So I mean, it's just ridiculously cheap. It's a turnaround play, as I mentioned. A bit of restructuring. They went through some hard times, and now their balance sheet is much stronger. They've had a few spin-offs, and they've got a new CEO who is much more, in my opinion, tied to the performance of the business. Portfolio of top tier oil and gas in the USA and Canada. So interesting, as I've mentioned in the past, federal land permits for oil and gas, it's hard to know. The Biden administration keeps on changing their tune, but they were initially not issuing any new permits for fracking or shale on federal lands. And so apparently someone told me in the comments that they've changed their mind. They could do, who knows with them. The company has their assets in jurisdictions that have retained some of their sanity, okay, of which there are relatively few in the US. No offense if you're watching from the US, but jurisdictions like Oklahoma, Dakota, and Texas are where the bulk of the assets are. So their state jurisdictions are much more developer and production friendly. They have a horizontal drilling technique that they use, and it's much more efficient. So if you think about digging into the ground, they can dig for the wells and dig horizontally rather than play whack-a-mole with the assets in terms of their leased land. So they've got a little bit more of an advantage in terms of the efficiency of production mechanism. Okay. A quick look at their production. So as you see, most of theirs comes from the Permian, which I believe is in Texas, Anadarko in Oklahoma, if I remember correctly. Bakken, I think, is in North Dakota. And you can see that millions of barrels per day of oil production, and there are millions of NGL, which in Australia we call LNG, liquefied natural gas. So that always messes me up a little bit. And their cubic feet of natural gas production. Okay, oil makes up most of the revenue. Okay, so about 55%, might be a little more, might be a little less, depending on the year. Natural gas is at 26%, okay, and LNG at 19%. As I mentioned, their goal is to be at around $3 billion in net debt by 2023, which would be a very, very good position for them to be in. What I don't like are their hedges for natural gas. Okay, their oil is about 44% hedged, and they're at okay prices. I'll show that in the next slide. Natural gas, I don't know what they were thinking. 81% of production hedged. I mean, that's just silly. Maybe they needed finance, and as a covenant in their finance, they needed to have their prices hedged. I'm not sure, but it makes very little sense to me as to why they hedged A, so much of their production, and B, at such low prices. Anyway, looking at about a 6% yield, and that yield will double. The company made an announcement. Once they hit the $3 billion net debt goal, they will double their payout ratio. Okay, so as a dividend, you're going to be looking at, who knows, if you buy today and hold on, it might be close to a 12% yield in dividends alone, because the company is just producing so much free cash flow. It's amazing. Oil demand is much greater than supply at the moment, as we've been learning about through the energy crisis that's going on. $70 a barrel should remain stable over the next at least 3 to 5 years, if not for longer. Okay, here is a copy of their hedges. Okay, so this is the hedging table taken from an article that I read. Thank you to the gentleman on Reddit. You've saved me a heap of time putting this into a spreadsheet. So if we look at the oil up the top here, okay, at the collars that they've used and their derivatives hedged out to 2022, at the end of 2022, if I was the CEO of Ovintiv, I would be absolutely pounding the table wanting higher prices if their buyers want to have a guaranteed production and hedge it out. I think that oil is only going one way for the foreseeable future. And so as you can see here, during the leaner times, they had a lower percentage of their production hedged out at tiered costs, or tiered prices. But as you can see, they were basically hedging their losses there. Okay, they're not making any money at less than $35 a barrel if you include cost of capital and everything else that goes into pulling the oil out of the ground. 70, of course, not so bad. So the collars are a little better here. But if you look at this, look at how they've hedged out their gas derivatives. I mean, it's just insane. At the highest price, they're $3.30. That's half of what gas contracts are trading for on the futures market today. I mean, it's just, and 63% of production. I mean, I don't know. Anyway, that is what it is. By the end of 2022, they should be able to renegotiate. I don't think the natural gas bull market is going to end by the end of 2022, so they should be able to have an extra kicker on their free cash flow from that 26% of revenues that comes from the gas arm of the business. So yeah, silly. Don't know why they did it. If you listen to Eric Sprott, which you should be, okay, do yourself a favor. There's a great interview in which someone asked him about his thoughts on hedging. Okay, now Eric operates in the metal space primarily. However, his answer is golden. He said the whole thought of hedging makes me want to puke. You go through these cyclical declines and secular bull markets where no one wants to know, no one wants to buy your gold or silver or platinum, palladium, whatever it is. He's in the metals market. And then all of a sudden, when macroeconomic factors dictate that you're finally going to make some money, you're going to limit your upside by placing hedges. I mean, he just nails it. It's so silly. It's particularly capital-intensive businesses like natural resource businesses or any commodity-based production and selling. You go through oversupply, undersupply, oversupply, undersupply. And when you're oversupplied and the spot price tanks, you're losing money year on year on year. You have to, over 10 years, let's say, for a typical cycle, when you get to the end, which might be 1 or 2 years of good times, you've got to make the most of it. You can't be limiting your own upside by hedging. Anyway, so it's worthwhile listening to Eric Sprott. That's my moral of the story there. If we take some of my favorite oil companies and with different plays, so we've got Transocean at the top there, rig, which is an offshore driller and leasing of their drill rigs. And you've got Ovintiv here, okay? And then we have Synovus, which was the spin-off, which is a very high quality, in my opinion, Canadian oil and gas play. Southwestern Energy and Lukoil, so the Russian producer. You can see how they've performed over the past year. So you can see the leverage to the oil price is the difference. So when we're talking about Ovintiv, they have a higher debt level. And do you remember I was talking about ExxonMobil? Sometimes when you have a marginal producer, if you're sure that you're going into a bull market for the commodity which that producer sells, it's a strange phenomenon, but sometimes the sillier your investment, the better you actually do, because those that are highly leveraged they have a disproportional benefit to the increase in the commodity price. So as you'll see, some of the better businesses, although I don't know, Southwestern Energy was quite indebted, so I probably wouldn't put them in the same basket. But where you have the high quality and bigger producers, they did well, obviously. I mean, 1.7 times your money in a year is fantastic for Cenovus, but they have a much lighter balance sheet. When you look at these guys who were looking at bankruptcy, they've just smashed it out of the ballpark, okay? So if you can time it, there's a real art to it. If you can work out who is going to survive that initial drop, so March, April 2020, when everyone was mortified in the oil industry because the futures went negative and their businesses were basically staring down the barrel of bankruptcy. Those that restructured that could get past that, they're highly leveraged to the oil price. It's basically like a call option. Because as that oil rises, you can see here, they have a disproportionate level of performance. Okay, so our projections looking out to 2023. Okay, let's say everything goes as we anticipate. Here, we're not anticipating anything crazy in the price of oil. Okay, between $70 and $80. This is reasonably conservative. Free cash flow is expected to come in at about $14.31 a share. EBITDA on a per share basis, $15.32. And earnings looks terrible because they have a lot of non-cash expenses and write-downs. Okay, so part of that is the hedging. So according to the accounting standards, if you really want to get into the nitty-gritties of it, they have to mark that down in the earnings. Okay, which is why earnings are not as good a metric, in my opinion, to use. Free cash flow is what it's all about for me. EBITDA, a lot of other people use, and that gives us a good indication as to the enterprise itself when you take away the cash and just look at the business itself. So if we apply these multiples here, which I know you're going to be saying, well, that's crazy low, and it is. With the political winds the way that they are at the moment, I don't expect to see huge margin multiples increase over the next 3 to 5 years. Definitely not over the next 2 years. So we are looking at, okay, if we just get very conservative multiples on these cash flows, what are we looking at? If we get a higher reversion, meaning investors finally realize that these businesses are absolutely printing cash, then it's all upside, okay? And we may have a nice little bonus on the upside. So here are the implied prices for those inputs. Average price expected, if projections run true, $68.63, which is about 180% again on the upside over the next, call it 2 years, okay? Two and a bit years, which is fantastic, okay? It's a great IRR. We take those cash flows. This is our entry price, okay? This is what we got in at. The share price is up, I think, about 10% since we bought it. Our position's up about 20% because we used a little bit of leverage. Here we've got the expected cash flows and discounted at the average cost of capital. See how much debt they have and the interest applied to oil and gas companies. This is why production is going to continue to lag, because no one wants to. Not that no one wants to, no one's allowed to. They're giving into the political pressure of being able to finance this new production. So I hope you don't drive a V8 like I do. That's why I've been on the bike to work, because petrol is not going to get any cheaper. Okay, so having said that, we discounted at their cost of capital. We're looking at an IRR of nearly 28%, okay, which is phenomenal, okay, phenomenal. Not a fancy business, simple business to understand, and would we take 28%? You better believe we would. Okay, here I've done something a little different, 2 comparisons side by side to highlight a few points, okay? This is what the share price is trading at today. So if we buy it at today's price, run through those cash flows, discount it at the cost of capital, and we only reinvest it, meaning we don't just buy back into the business and keep the same cost of capital. We take it out and we, put it in an index fund or something like that gives us a nominal return of 7%, okay? We're still getting 29.39% as an IRR, which we're not going to complain about, okay? If we compare that though, if we just get a few of these, we squeeze out a little bit more performance and say, okay, well, if you were an investor in the Crassus fund, for example, your entry price on average would be this. It would be $33.80. Now, as you can see, same cash flows, okay? So same projections, same inputs, discounted at the same cost of capital, but we've said we can reinvest it at the same cost of capital for the company, then you're looking at 34% as an IRR, okay, which would double your money in about 2 years, I believe. I'm sure the math whizzes will let me know if that's incorrect, but I mean, that's just incredible, absolutely incredible. So if we look over 10 years, obviously there's greater uncertainty over a decade than there is the next 2.5 or 2.25 years. But we use these inputs and we apply probability weightings for all of them, okay? So we take base case, bull case, bear case, using historic growth for the base case, and then cutting it back for the bear case, increasing it a little for the bull. And we're, again, conservative with the multiples because we don't expect our gains to come from multiple increases or even reversion to the mean. We're just going to keep it at a very simple, very conservative number. And we do this for EBITDA metrics, free cash flow, and earnings, which you can see are artificially dragging on the overall valuation because they're further down the income statement, if you really understand the way the accounting works. And so they have a lot of non-cash expenses. Makes them look worse than what they are for most businesses. Anyway, average of the three, intrinsic value, $77.64. So if we want to get our 20% yearly return, and I'm careful when I say that, it's a compounded annualized average. So it doesn't mean you get 20% every year flat. Some you might get 100% and then negative 50% and so on and so forth. But if you annualize the average over 10 years and we say we want a minimum of 20%, we have to buy the shares at no more than $77.64, providing that we're accurate with our projections. Margin of safety, can we, Charlie Munger's question, can we buy the shares at 2/3 of that value? And yes, we can today, okay? $38 compared to $51. In my opinion, I'm getting very, very excited about this particular business, okay? All right, my verdict for me, it's a buy, okay? It's got lowish debt, okay? I wouldn't say low debt, that's arguable, but they're paying it down. They are smashing it down. If you look at their interest expense to their EBITDA, they're able to service that debt no problems. And if you look at the way the management is running the business, they're not looking to expand production. They've said, we're going to be doing very well from a free cash flow perspective. We're going to take that cash flow and we're going to smash down the debt. We're going to buy back shares. We're going to give out dividends and basically be good managers. I mean, fancy that. They're actually going to care about the shareholders. Who would have thought? Margin of safety is there. Sales growth is there. Strong margins are there. Free cash flow growth is very, very good. And I think will outperform expectations over the next 2 to 3 years. We've got 1.5% of the assets under management. So that's the equity. And I have used a little bit of leverage. So if you take that into account, which I always do, gross weighting is about 3%, okay? Equivalent. Now, if you are unfamiliar with leverage, don't use it, okay? Just leave it to the pros because otherwise you're playing with fire, basically, okay? And that's that. So long one today, but lots of details to cover. I hope you enjoyed it. I have many more things to say about the oil market, which I'll do in a separate video. And we have other particular energy stocks that I want to talk about because I've just added them to the fund. Okay, so we have to start somewhere. If you haven't already checked us out on eToro, please check the link below. It will take you there. If you have some funds that you want to invest, I think the minimum is $200, and if you've got $500, that syncs properly. So you get a better sync with the positions in the portfolio if you add $500 and copy the trade. Otherwise, add us to a watch list and keep us in your thoughts. If you follow me on Twitter at the ROI channel, I put out a few thoughts, not many, but a few. And follow the YouTube channel by liking and subscribing, and you'll get access to more ideas and videos such as this one. Disclaimer, as always, use your noggin, guys. Don't necessarily believe everything that you hear on the internet, and make sure you do your own due diligence. You're responsible for your investments, and so make sure you're being sensible. Having said that, I'm going to shoot off. Thanks for watching, and I'll be back with another video next time.